when there is something expected um, to happen in the future, at the time of expecting, they also understand that there would be some variation. Let's say that, for example, for the future, there would be demand for 10,000 units. So that is what is estimated, and planning will be taken up according to the demand arising at 10,000 units for the next period. Everything else would be planned. But right at the time of planning itself, if they understand that there is a possibility of having a variation would be there. That is, they see that because of certain factors, certain reasons, um, the demand could be less than 10,000, say 9,000, or more than 10,000, say 12,000. If they see that certain factors will also cause some variation in the expected value. So when variations are expected to happen, when they see that um, this could happen, that could happen, something else also could happen. So what are we basically talking about? The variation in the expected value is referred to as risk and uncertain. Both of them mean the same thing, but the the difference in risk and uncertainty will be according to what Ajay Krishnan has mentioned. See, the when there is a variation, what is the likeliness of the variation or the probability of that variation also, if it is known, then we call that to be as risk. If the probability or the likeliness of the variation, if it is not known, just that the variation would be there is known, then we call that uncertainty. If the probability of the variation along with the variation is also known, we call that to be as risk. So risk is mentioned here. Risk is equal to variability in future returns, but the risk is quantified or calculated as the probability of such a thing happening into the impact on account of variability in the future return. So that is calculated as risk. But in case of uncertainty, there would be that probability would not be there. It would not be known about what is the probability of the variation is not known. So what is the total amount of loss which could occur cannot be quantified. Okay, so that is the main difference here in case of risk and uncertainty. See, here it also says that there could be upside risk and downside risk. Risk need not be all the time looked at as unfavorable or a negative tone, but then it can also be seen as upside. Upside is a favorable thing. See, if they are anticipating that 10,000 units would be sold, and if at all, if there is a variation and they end up selling 12,000, there is a variation, but that variation will be a positive variation. So it is taken as both an upside risk and downside risk. There are certain other factors also we have to learn in risk and uncertainty. We would be learning about the concepts, the various research techniques which are used so that they get the information about what are those factors which cause variation, or how much variation could be caused. So information should be available. So how this information is acquired, what are the ways in which the information is acquired, the research techniques which are available. We have certain concepts like scenario planning, simulation, then sensitivity analysis, then payoff tables and expected values are numerical part which we will be looking into today's class. So scenario planning, simulation, and sensitivity analysis will be learned. These are theoretical concepts, so let's learn them. So if the amount of risk has to be calculated, if the assessment of risk has to take place, then what are the factors, or what are the events that cause an impact? The events which result in some impact on the business. So that has to be first identified. Uh, for example, internally, if they get to understand that there would be strike called off by the employees, so then that affects the productivity. So there would be a variation in what expected profits they were expecting, what profits they were expecting. So there would be a variation in that. Let's say that governments uh, either stops giving a subsidy or it starts giving a subsidy. See, then either it would be adversely or favorably affected. So there's some change which is happening in the external environment. There is severe competition. New players also have entered into the market. So the customers get attracted to them. So demand would fall. Suppliers do not supply material or suppliers give a discount in the price. So these are external factors. Internal factors, we can see that maybe there's some dispute in the organization. Maybe some fraud internally happened that things are not in place. There are various things which can happen to the business. On account of that, would arise. So when risk would arise on account of that, um, first they should understand what are those events which can cause risk to the business, which can cause a variation in what they have anticipated or expected. Then how to get that information, how to find out that. So we see that what are the research techniques we see. Um, Either they can themselves find out uh, or acquire this information, or they can use it already which is um, published by someone already, which is present available. That information also can be used. So you must have heard about primary data and secondary data. Primary data is something which they themselves find out and then get that first hand information. So they acquire the information. If it is secondary information, someone else has worked on that information. They have acquired that and it is already published. So it is available. They just have to use that information and then draw some insights about that. So we see that desk research wherein the information is already available, either company records or general economic intelligence, specific market data. So these are published data. Um, see, Company records, government records, published resources, all of them. See, the work is already done by someone else. It is available. It just has to be taken, use it, and then draw whatever insights or inferences one has to draw. Otherwise, they themselves can personally enter into the market. Okay, they can take up the field research and find out what is the opinion, motivation, measurement. See, what does that mean? See, when they themselves find out the information, they get the information, they collect the information. In that case, see, they could be the information which is collected could be in terms of facts and figures, or it could be in terms of interviews, or it could be in terms of opinion. So some way an interview is conducted, I mean a video interview, audio interview, then from that insights have to be drawn. So when they enter into the market, all that information on first hand we cannot be collected in quantitative values. The facts and figures, it is not necessary that it would be in that particular fashion. Okay, opinion, motivation, measurement, then they can have questionnaires circulated, experiments, observations, group interviews, trade testing, focus groups. All these things are various ways in which they collect the information. Then we would be looking at what is scenario um, planning. See, as the planning is taken up for the future. So when planning is taken up for the future, so the base for planning is the past data. So they generally observe the base is taken as the past data, take some information, so draw some insights out of that, and then build up the plan for the future. That is normally that is the practice. That is observe what happened in the past and then understand what could repeat in the future. It says that identify high impact, high uncertainty factors. High impact, high uncertainty factors from the past. Whatever happened in the past is observed. So first identify what are those events which can cause high impact, or those factors which are quite uncertain and there is great impact on the business because of these things. Identify different possible futures. So what could again happen in the future also can be identified. Identify different possible futures. The from among them, the ones which are consistent, they repeatedly happen. They repeatedly happen. The variation in the demand. There's too much of fluctuation. Um, See, there may be availability of some resources consistently troubling, so it is not available. So what are those things which are which happen, which can cause some issue to the business? Out of that, the ones which are consistent, identify consistent future scenarios. So basically, what would again repeat in the future is identified. Note down it as a scenario, then take up planning. If such a thing again happens, because the chance that such a thing would again repeat in the future, if it is there, note down that as a scenario. Once it is noted down as a scenario, then the planning for that scenario will be taken up. So if the same thing again repeats, like wave 1 and wave 2, whatever wave 1 happened, the same thing repeated in wave 2 also. So uh, this was anticipated. Many have anticipated that yes, this would repeat once again. It is not that one time event, it would again repeat. Then the planning, see whether the planning was there in place or not, we are not commenting about that. But then planning can be taken up accordingly. So also in business, we see that favorable, unfavorable, whatever it is, whatever happened in the past, there is a possibility to happen in the future. Identify such things. There is so much of information available from the secondary research, primary research. Some information would be available, whether or not this would be repeated. If they understand that they are consistent to happen again, even in the future also, note down as a scenario, note it down as a scenario, and then take up the planning for that scenario. Then for each scenario, identify and assess possible courses of action for the firm. So, what should be done if this repeats in the future? If the scenario repeats again in the future, what should be done? How prepared should the business be? Is what is a plan. Then, when the actual thing happens, so whatever is the plan which they have prepared for the future, is the reality happening in that particular manner? Is it the same thing which is repeated? Is it the same thing which is implementation, whether it is implemented in the same manner? So monitor that, observe that, and then if there are any um, uh, if the plan is not properly implemented, measures are taken to implement it appropriately. Then if the plan was not appropriate in the first place, in future whenever they are taking up a plan for the future scenarios, they will properly plan. So revise the scenario and strategic options. So that is about the scenario planning. Whatever happened in the past is observed thoroughly and identify those events which have high impact and high uncertainty factors, and identify if some of them can repeat even in the future. If it is identified to be repeated in the future, note it down as a scenario and then take a planning for that scenario. When the plan is implemented, observe the plan, how it is implemented, observe how the implementation is going on. If the implementation is not proper, then measures are taken to implement it properly. Otherwise, if the planning was not sufficient, if they were not prepared, see, all the governments have failed in terms of planning for the second wave. They have not prepared for um, enough number of beds or oxygen arrangements or whatever the medical requirement was there. So all governments, irrespective of whichever party, we see that in India, that was a major failure what is observed. Then oxygen things, and then um, even in terms of providing proper vaccines. So we see that the planning was not appropriate. So when the planning is not appropriate, definitely that will have an impact. So if in such situations, if there is no proper planning, then measures should be taken to take up the planning better for future. So revise the plan and implement it for the future. Next, we have simulation. There are two things which are almost similar but with a difference. One is simulation. There's another one which is called as sensitivity analysis. Simulation and sensitivity analysis. See, when there is a set of when there are set of inputs which are introduced, then an output is generated. So there are certain key factors, there are certain inputs which will give the desired result. If there is a change in these inputs, then there would be an impact on the output. Change in the inputs and observe what happens on to the output. So here it says that randomly apply probabilities to key factors in scenario analysis. So scenario analysis, when planning is taken up, then under simulation, what is done is various alternatives when they are present, there are the risk is basically variation in returns. So variation in returns, let's say that there are three variations. We were discussing about one example of demand. Demand could be either 10 or it could be 8. It could fall down to 8 or it could be above that and it can be 12. So if there are three different possibilities which are anticipated for the future, along with these expectations, we also should have a probability mentioned. Let's say 30% chances are that the demand would be 8,000. 50% chances are that the demand would be the same, 10,000. Um, then 20% chances that the demand would rise to 12,000. So if this is what is anticipated, then how do we calculate? We multiply each of them 8 into zero point 0.3, then 10 into zero point 0.5. So this is also called as expected value. Then 12 into zero point 0.2. After we multiply whatever are the values, the sum total of that is the expected value, or that is how what would happen in the future is anticipated. So risk is calculated in this particular fashion. Now, when there is a change in the variables. So the variables, the probabilities, if they change that, use random numbers to select a particular scenario and calculate outcome. So they keep constantly keep making changes and then observe what is the impact on the output. Anything randomly they keep changing the numbers. Multiple times the same thing is experimented and then identify what is the best possible outcome. Repeat until build up a picture of possible outcome. So many things. Let's say if this changes by if this is 40%, then this is 50%, so this becomes 10%. So one at a time, multiple things at a time, like that. Many changes are taken into consideration for calculations, and then take a decision about what is their appetite to take the risk. What is risk appetite? I will explain to you in a short while. So simulation talks about taking up the same thing, taking up the same experiment by making multiple changes to the given set of data, and then note down what is the output every single time. Note down the output and then based on the risk appetite of the organization, best decision is taken. The same thing is even mentioned in sensitivity analysis. Simulation is done multiple times, multiple number of times with multiple variables at a time, or constantly making many changes repeatedly again and again. So generally simulation is taken up with the help of a computer. So we also call that as Monte Carlo uh, computer simulation. So with the help of computer, Many number of times the same experiment is conducted by randomly making changes to the numbers. But in case of sensitivity analysis, this also talks about making a change in the input to observe what impact does it have on the output. But then here it is can only vary one estimate at a time. So taking only one estimate at a time, then the experiment is conducted or the result is noted down. That is about the sensitivity analysis. Simulation, multiple inputs, multiple variables are changed randomly and the output is noted down. Then we have in between these two things, there is one concept called as what is expected value. Expected value is, see, when there are three different possibilities which are expected, instead of being biased and going ahead with only one variable, see, they can also decide that yes, because 10,000 is what is expected, it would happen. Um, let's get let's just plan for 10,000. Or a pessimist person thinks that, see, on the worst side it can fall down to 8,000, so let's plan for 8,000 units and then plan everything for the future. Optimistic person will go ahead with 12,000, so it sees that everything is bright, and then chances that the demand could rise to 12,000 is a very, very favorable thing. So the decision will be to go with the plan for 12,000 units. See, these are three different possibilities. But expected value says that instead of being biased towards any one particular variable, consider all of them. Take up the all the three expected values and take up the planning. So on an average, that is considering 8,000, 10,000, 12,000, all of them are multiplied into respective probabilities and find out what is the sum total of the outcome multiplied with its respective probability. So that is expected value. So this is the attitude of a risk neutral. So neither going with the pessimistic view nor the optimistic view. A neutral person, risk neutral person, understands that, see, everything is a possibility. So on an average, considering the average value which is 10,000, or a worst scenario of 8,000, or a very best scenario of 12,000, all of them are anticipated. They are multiplied into the respective likeliness of happening, probability of happening, and then the decision is taken. So this is about a risk neutral person. What are the advantages? The advantages are recognizes that there are several possible outcomes, enables the probability of the different outcomes to be taken into account, leads directly to a simple optimizing decision rule. Calculations are, you just have to multiply that. Calculations are relatively simple. There are disadvantages also. Probabilities used as subjective. That is the main point. See, when we are saying that probabilities are used, how do we understand what are probabilities? There is no way. That is only based on experience and past information, or from some source. They just understand that this is a chance. See, now that the southern states and then the western belt is all um, affected with this cyclone, then we see that the weather is, see, in everywhere we see that it is cloudy. What is the chance that there would be a rain? We can go as 80% chance, 90% chance also can be mentioned. Okay, so we see the entire western belt is getting is now is affected with the cyclone. So rains are very, very common. So anybody asks what is the probability that there would be rain, then from that experience, from the when you look at the sky and then understand that this is cloudy, so the chances of rain happening are quite high. Therefore, you would say that 80% probability that it would rain, 90% probability that it would rain. But on a very sunny and a clear day, when somebody asks what is the probability that it will rain, you will say 10%, something like that. Out of experience, these probabilities are mentioned. So they are again subjective. So probabilities used are subjective. It is dependent on the personal understanding or judgment of an individual. They are subjective. EV is the average payoff, not useful for one-off decision. The average is taken. It doesn't go with one particular decision. They are considering all the three of them. But precisely one thing is not available there. Okay, so this is just the average of all the three things. Then expected value gives no indication of risk. Nowhere risk is incorporated into that. Ignores the investor's attitude to risk. Then we have the next concept. From here, the numerical questions start. The next concept what we have is about the payoff tables. See, first what we need to understand is investors are of different types. Um, from our family, see, from the individual families and family members only, we can identify this difference in the attitude or their perception towards various things happening. So we can understand that from our individual family also. See, the elderly people generally they prefer investing in less risky investment opportunities, like they prefer investing in bank savings account, FD, something like that, post office, NSE certificates, government bonds. So these are the things which they prefer because they do not want to take up a risk, and then they do not want their investment to go down the drain. So they just generally choose those things. But in family, some of them, the younger lot, not always, but they may prefer investing in much dynamic investment opportunities, like they can invest in real estate, gold, stock market. See, these are the things in which they would prefer to invest in that. Um, See, the elderly people here, what example, what we are taking, the reason for them choosing these investment opportunities are their investment would be secure, safe and secure. Investment, see, there would be no way that they will lose their investment. See, the bank will pay off their amount whenever they want to withdraw it from the bank. But in case of these in the stock market and other things, the chance of losing their investment is also there, and that sometimes depends. It is high or lower. The possibility is there that they may lose their investment. Okay, so risk aspect, we see that the conventional investment opportunities have lesser amount of risk. The other things have more amount of risk. So we see that risk and return, if we are talking about, see, certain investments or opportunities have low amount of risk. So when there is low amount of risk, okay, risk is low, banks pay very less amount of interest. We also understand that, isn't it? Anywhere else, if it is invested, it multiplies so many folds, but in case of bank, the rate of interest which is paid annually periodically is very less. So when risk is low, we also see the feature that return is very low. But the other investment opportunities like stock market, real estate, gold, precious metals and all, we see that the risk is quite high. When the risk is high, we also see that when they earn a return, the return is also quite high. So the now, why would anyone choose a particular investment opportunity? It is based on their attitude towards risk. Not necessary that always the older lot go with the conventional. They can also be taking dynamic decisions about investing in stock market, real estate, etc. I mean, generally, to make it simple to understand, I just mentioned it, but it could be the other way around also. Sometimes the younger lot could be very pessimistic about choosing the dynamic investment opportunities. So it could be the other way around also. But for simplicity and then simply understanding, I gave that example. So we see that basically um, the perception towards risk differs from person to person. There are people who are quite optimistic in terms of investing, so they are also willing to take up the risk, whatever is the risk present. Some of them are pessimistic, so they even want to forego their return just to ensure that there is no risk which is present in their investment opportunity. Focusing on that, focusing on that risk appetite and attitude towards taking up the risk, we see that there are certain um, decision choices which the people would choose for different things. So that is presented as expected value, maximax, maximin, minimax, regret rule. So these are the things which are given. The different decision choices are given for different possible scenarios. So let's see what they are. Expected value, just now we've done. What is expected value? It talks about risk neutral attitude of the investors, wherein he would consider the best thing, the average thing, and the worst thing. All of them are considered by a risk neutral person. So that's expected value. Then Maximax is a risk seeker. He wants to maximize his return. So the term has maxi max. So there are two maxes here. So it should be split into two parts. The other one maxi min also. Maxi is one part, min is one part. So when there are alternatives available, from the alternatives, the investor chooses those opportunities where the return is maximum. First selection is select all the maximum, uh, select those alternatives which give maximum return. Then out of that, from among the maximum, then again go select with the maximum one. Maximum among the maximum alternatives, maximum profits. Maximin talks about first go with what is the minimum amount of return which can be earned. After selecting the minimum returns from among the alternatives, the maximum is selected. Okay, maximin. So risk seeker, risk averse, and risk neutral. Then fourth one is minimax regret rule. So let's take it up. We'll work out the questions based on these four things. So first to solve these four different decision techniques, we need to tabulate the data. So that's what is called as payoff table. So that has to be presented in such a way that it becomes easy to take up the calculations. On the screen, question number 129. The same data set is given, and we are asked to calculate all four techniques. Dealing with risk and uncertainty in decision making. Question number 129 talks about Shuffle's company uses forklift trucks in its warehouses. The management accountant is deciding which grade of trucks to buy based on company's risk appetite. There are three grades of trucks: the A series, B series, and C series. The decision for the truck is dependent on Shuffle, Shuffle's company's growth in its online market, which could be at 15%, 30%, or 40% for the next period. The management accountant has correctly produced a payoff table showing the daily contribution earned for each of the outcomes. Can you see the Excel sheet? Can you see the Excel sheet? Okay. So let's solve question number 129. What are we asked to find out? We are asked to find out if Shuffle's company is risk averse. If the investor is a risk averse investor, what is the decision of the investor to go with? Risk averse is to go with maxi min. Risk averse investors will choose maxi min. So the decision is dependent on what is the solution for maxi min. We see the payoff table is given. What information do we have? Let's first identify what is the information which is present. The decision for the truck is dependent on Shuffle Company's growth in its online market, which could be, there are three different growth possibilities which can happen for the next period. Either the growth in the economy could be, or growth in the market could be 15% or 30% or 40%. So these are three different possibilities which are present there. Then the decision is about which grade of truck will it purchase. So grade of truck, there are three different grades of truck. So the types of truck we have it as series A series truck, or B series truck, or C series truck. So there are three different possibilities here. So which one, the choice is about which truck would they go with selecting. The selection is about which truck. If they have to choose the truck, the selection of the truck, amidst the different possibilities of the growth rates. So it could be the market could grow at a 15%, at 30%, or 40%. So if there is 15% growth rate, they see that by choosing truck A, they can earn a contribution of 2,400, 1,800, or 3,600. Similarly, for 30% and 40% also, what contribution can be earned is mentioned. The investor is a risk averse investor. So the choice will be about maximin. So if the choice is about maximin, first step is they would go with choosing the minimum return for each of these trucks. The return which would be expected will be minimum. So highlight all the minimum returns and then after that select the maximum out of the minimum returns. Now let's start identifying what is the minimum return. If truck A is chosen,